All right, let's dive into the inflation numbers in line with expectations. A jump from a year ago, of course, but the bar was pretty darn low. Let's bring in Michael Ashton, joining us from Enduring Investments. He is the inflation guy, of course. Michael, good morning. Good to have you here on Inflation Day. So let's first start from the top line. What should be our primary takeaway? That the inflation's not running away from what analysts expect or understand?
Actually, inflation, the core number was a lot higher than they expected. 0.2 is what people were looking for. The market was around, high 0.2s, and we got like 0.34. So we almost got double what people were expecting. So in fact, actually, core inflation was a lot higher month on month than people were looking for.
Okay, so I'm looking at the top line CPI 0.6 for actual, consensus 0.5, but you're saying the core number here, which remind us takes out what?
Yeah, so core takes out food and energy, and so it tends to be a lot more stable, although over the last year not so much. There's still those big base effects you're talking about. And so more than normal, we really do have to look at the month-on-month figures. Normally those have so much noise that we try to avoid looking too much at the monthly. For the next 5 or 6 months, you're going to have to, because the year-on-year is going to go all over the place.
Now, all right, so if it's going to go all over the place, you're saying we can normalize that by looking at the core inflation. The market seems to be pretty comfortable with this right now. Bonds have firmed on this news. So what do you make of that response?
I think that the Fed has made really clear that they're going to err on the side of providing too much liquidity rather than too little. And so, even though this number was higher than expected, break-evens are higher on the day, we all know that doesn't mean the Fed is going to be tightening anytime soon. The fact that we have all these weird base effects for the next 6 months means that they can, and they've already been out sort of saying, don't really worry about the spike in inflation that we're about to see. It's all base effects. And the problem is it's not all base effects, but they'll be able to sort of spin that story now for 5 or 6 months. And that's kind of what they want to do right now. They have no interest in tightening.
So to come back to that core number here, the year over year versus the month over month. The month over month is the one that surprised a little bit more, right? Is that more important because it is the kind of momentum, the rate of change for the current status of these indexes?
Yeah, sort of. I mean, you're sort of looking at the same thing. Year on year surprised a little bit as well, and almost surprised by 0.2, which is a big miss on a core inflation number. But a lot of the jump, as you were saying, a lot of the jump this month we sort of knew was going to happen. Next month it's going to be even more dramatic. Core inflation is going to go up to 2% higher or higher. And so, we sort of know that's going to happen. What I wanted to look at was if you look at core, and let's look at what it is that's moving in core and see if we're getting the add backs we thought. We sort of knew that even though the economists thought we'd get a 0.2 on core inflation, it smelled like it was going to be higher because used car prices have been going crazy, rents have been going crazy, lots of shortages and things, and so it's sort of that's what we're really looking for, is evidence that those shortages are more than just kind of one-offs, but things that are going to persist for a while. And
what is that looking like in terms of the direct observable impact of some of these supply chain constraints? Can we see that in the chip or tech products or any kind of hardware specifically?
Yeah, actually, right now, the place it really shows up, and it didn't show up in CPI yet, but it will in the coming months, is used car prices are going through the roof again. This time because of a shortage of semiconductor chips that's kind of affecting the new car market. And also last year when rental car fleets contracted, that means that there's less supply of used cars on the market this year. And so you kind of put those two together. Hard to get a new car, and used cars, there aren't as many of them, and you're seeing those prices go through the roof. So you got a shortage there. There's shortages of containers and packaging materials and all kinds of other things that are global supply chain issues. And those things are sort of percolating and showing up in other places as well. If you look at core inflation ex housing, so housing is the big slow moving piece. Core inflation ex housing is back to where it was prior to COVID. So we're already kind of at the inflation level we were already at going into COVID, and rents are sort of artificially depressed right now for some technical reasons. So it actually looks like inflation's a little hotter here than we should be really comfortable with.
Now, Mike, the kind of knock-on effect from here as the potential for spending changes, right? We've been buying things that have been fairly specific, right? I mean, there's some stuff here that's like way in the negative category, some of the apparel items, some of the things that people haven't really needed. You mentioned the autos and the cars. As people moved out of the cities, they bought homes in suburbia, they bought cars as well. Is there any way to know if that type of buying demand will find its way into other products to shift the broader index higher? If someone can buy a car or a house, surely they can buy whatever else they want.
Well, this is the debate, right? So, is this a temporary kink in the supply chain, or is this, something systematic going on? And inflation isn't, although we think about it as kind of a general rise in prices, that's not how it happens in practice. It's more like, a bag of popcorn, microwave popcorn, that, the kernels start going off one by one, and inflation is when you have a bunch of them going off. Not all prices are moving at the same time, but they start popping more rapidly. So we have a lot of anecdotes here, and the question is, are those just one-off anecdotes, or are they part of an acceleration in the popping of those kernels? That's what real inflation dynamic is. And we're not going to know that for a while. Traditionally, the Fed would right now be preemptively, pulling back on some of the liquidity, but this is not a traditional Fed, and we're not in a traditional cycle. And so they're going to wait and see. And if they're wrong, they're going to err on the side of having too much inflation rather than too little employment.
Okay, so the conclusion here is core inflation is rising at a pace a little bit faster than what analysts have expected, a decent amount faster. The overall top line is still generally within the realm of expectations, but there is a fair kind of logic that the pricing will continue to reflect the ability for people to spend, the fact that they've got savings built up, the debate that you mentioned here about what they kind of buy next. And then, of course, all of this in the context of a Fed that is not worried about inflation. So we don't have that counteracting force from the Fed. Is that going to be enough alone, Michael, for this number to drift higher continually? Or do we really need to see people deploy their savings? Is there an organic kind of expectation we should have based on current expectations for the economy? Or do we need to see some surprising degree of spending on behalf of those big savings that have accumulated?
That's a great question. All we really need, there's lots more physical money out there, not physical like dollars, but the actual money supply itself is much larger. The reason we haven't had more inflation so far is that money velocity has been really low. People have not been spending it as quickly. It's been accumulating as savings account balances and not turning over quickly. You don't really need that to be a surge of spending. You just need to have it go back to kind of what it was historically. And that will happen when people determine they need less of a precautionary cash balance. They don't feel like they need to keep as much in reserve. They'll go out and start spending again. So that normalization, I think, is going to happen over the next 5 or 6 months at exactly the same time as the crazy base effects are covering up what's actually going on. So I think but the next time we'll get a really clear picture of what's going on, not going to be till really late this year. And meanwhile, the inflation dynamic, that normalization is already happening. And it's going to look like anecdotes to some people. It's going to look like a broad trend to other people. And it's just going to take a long time to find out. And it's a very dangerous time both to be a monetary policymaker, also to be an investor right now, because at some point, somebody is going to catch on that the Fed is going to have to do something, or discount rates are going to have to rise, and that's not going to be good for equities. Or the central bank will say, we're just going to fix long-term rates, and that'll be great for stocks. So it's a very, very dangerous time right now in both directions.
Okay, the hyper part of it, though, we haven't gone to, right? I mean, like what you're saying is we should expect the trend for inflation to creep and keep moving forward, and that maybe we'll miss the underlying trends. But what about the extreme camp where folks have been talking about risk of hyper blowback levels of inflation?
No, I don't think we'll get that. I mean, I think that we're not talking about 6, 7, 8% anytime in the near future. I think that a miss is you get core inflation, well over 3, which we haven't seen for a quarter century. And it starts to push 4, and then maybe it ebbs, and maybe the next cycle gets bad. But I don't. To get a really high number, you need to have either money velocity start really turning over very quickly, and that seems unlikely to be sort of sustainable. Or you need, or the Fed needs to keep printing a whole lot, which hopefully they won't. Or you need a collapse in confidence in the system, and that doesn't appear to be happening, at least so far. So I think that the conditions for having really ruinous inflation aren't there, but 3%, 4% core inflation is going to feel ruinous.
Okay.
We haven't seen it so long.
Okay. All right, Mike, thanks for the rundown here with the good analysis of the numbers that are in and the analysis of what numbers could be coming here down the pike. Michael Ashton, managing principal at Enduring Investments, the inflation guy on